Imagine standing at the edge of a vast, bustling marketplace, teeming with opportunities. This marketplace represents the world of stocks, where every purchase you make could be a step towards financial success or a misstep into loss. But how do you pick the most profitable stocks, aka the winners? By the end of this video, you'll know how to navigate this marketplace with confidence. To start our journey, let's understand what stocks are. Picture a giant corporation as a colossal ship. Owning a stock is like owning a piece of this ship. Each share you buy represents your stake in the company's voyage. When the ship prospers, you do too. But let's delve deeper into what this really means. Stocks, also known as equities, are securities that represent ownership in a corporation. They entitle the shareholder to a proportion of the corporation's assets and earnings. Essentially, when you purchase stocks, you are buying a fraction of a company. The value of this fraction can rise or fall based on various factors, including the company's performance, market conditions, and broader economic indicators. So why do companies issue stocks? Companies issue stocks to raise capital. This capital can be used for various purposes such as expanding operations, funding new projects, paying off debt, or entering new markets. By selling shares, companies can gather substantial funds without taking on debt. This process is called an initial public offering when shares are offered to the public for the first time. There are two main types of stocks: common stocks and preferred stocks. Common stocks. These are the most typical form of stock that investors buy. They give shareholders voting rights at shareholders' meetings and the potential to receive dividends. However, common shareholders are last in line to receive assets if the company goes bankrupt. Preferred stocks. These stocks typically do not come with voting rights, but they have a higher claim on assets and earnings than common stocks. Preferred shareholders receive dividends before common shareholders and have a higher claim in the event of liquidation. So how are stocks traded? Stocks are traded on stock exchanges such as the New York Stock Exchange or the NASDAQ. These exchanges facilitate the buying and selling of stocks, providing a platform for investors to trade shares of publicly listed companies. The price of a stock on an exchange is influenced by supply and demand factors, which are in turn influenced by a multitude of factors including company performance, economic conditions, and investor sentiment. So why do people invest in stocks? Well, people invest in stocks for various reasons. Capital appreciation. The primary goal for many investors is to buy stocks at a low price and sell them at a higher price, thus making a profit. Dividend income. Some stocks pay dividends, which are regular payments to shareholders from a company's profits. This can provide a steady income stream. Ownership and voting rights. Owning stock in a company can also provide a sense of ownership and the right to vote on important company decisions. Let's talk about the risks and rewards. Investing in stocks comes with its own set of risks and rewards. Stocks can offer high returns, especially over the long term, but they can also be volatile and unpredictable in the short term. It's essential to understand these dynamics and be prepared for the inherent risks involved in stock investing. By understanding what stocks are and how they function within the financial ecosystem, you lay the foundation for making informed investment decisions. With this knowledge, you're ready to explore the strategies and analyses that can help you pick the right stocks for your portfolio. As you embark on this voyage, you'll encounter two types of sailors: active investors and passive investors. Active investors are the adventurous types. They believe in beating the market by timing their moves just right. They trust that the market isn't perfect and that with keen observation and strategy, they can outsmart it. These investors are like skilled captains who navigate stormy seas, constantly adjusting their sails to catch the best winds. Passive investors, on the other hand, are the patient voyagers. They believe in the market's long-term potential and prefer a steady course. They don't subscribe to the ups and downs of stock picking. Instead, they trust the market to act as a long-term weighing machine, accurately reflecting value over time. These investors set their sails and enjoy the journey, knowing that time is on their side. Technical versus fundamental analysis. As you sail further, you'll need tools to navigate. Here, you'll encounter two essential instruments: Technical analysis and fundamental analysis. Technical analysis is akin to reading the stars and the waves. Technical analysts believe they can predict future highs and lows by studying charts and patterns. They look for signals in the historical data, hoping to foresee the market's next move. Fundamental analysis is more like examining the ship itself, its structure, its crew, its cargo. This approach focuses on a company's financial health, leadership, and brand strength. Fundamental analysts evaluate the intrinsic value of a stock by delving into financial statements and other qualitative factors. Think of these two methods as a scale. Sometimes you might lean more towards the precision of technical analysis, and other times towards the thoroughness of fundamental analysis. Once you've selected a stock and decided it's the right time to buy, it's often best to stay the course rather than jumping in and out with every market wave. It's worth noting that even the most seasoned captains, the professional traders, often find it challenging to consistently outperform a simple, low-cost index fund. This insight can save you from many stormy nights. The easiest way to pick a stock. So, for those just setting sail, the easiest way to pick a stock is to choose a stable, growing index fund, such as the S&P 500 or the MSCI All World. This fund represents a basket of stocks, providing a diversified and balanced approach to investing. However, if the thrill of individual stock picking calls to you, consider a balanced portfolio, perhaps 80% in an index fund and 20% in individual stocks. But how do you pick individual stocks? When it comes to picking individual stocks, your journey continues with both quantitative and qualitative analysis. Let's look at quantitative analysis. First, the balance sheet, which shows the company's financial position. There are three categories that are called assets. Current assets, items that can be turned into cash within 12 months. Long-term assets, buildings and other long-lasting investments. Non-tangible assets, brand recognition, patents, and goodwill. On the other side of the balance sheets are the liabilities. Current liabilities are debts to be paid within 12 months. Long-term liabilities are debts to be paid beyond 12 months. Let's do a quick calculation. Divide total current assets by total current liabilities. A ratio above 1 indicates the company can pay off its short-term debts. Secondly, there is the income statement. We can examine the income statement for the company's profitability. Let's go over some aspects that you can quickly have a look at. The top line, total revenue, represents the company's sales. The net income at the bottom line, showing the company's profit after all expenses. And there is something called the operating income. This is what is left over after a company subtracts the cost of goods sold and other operating expenses from the sales revenues it receives. However, it does not take into consideration taxes, interest, or financing charges. We can do a quick calculation here. Operating income divided by total revenue multiplied by 100. Ideally, this should be above 15%. Finally, the statement of cash flows. Look for a steady increase in cash flow over the years, indicating the company's financial health and ability to generate cash. After reviewing the numbers, delve into the qualitative aspects. There are 5 main points to look at after you did your quantitative analysis. 1. Brand analysis. Consider the company's brand strength and market position. 2. The news. However, be wary of market hype. Remember, buy the rumor, sell the news. News can drive prices up to unsustainable levels. 3. Leadership. Investigate the company's leadership on platforms like LinkedIn or X. Strong leadership can be a key factor in a company's success. 4. Emerging industries. Look for industries on the rise. Identifying trends early can lead to significant gains. 5. Sector shifts. Consider potential future shifts, such as the transition from coal to electric energy. Anticipating these shifts can position you ahead of the curve. By combining quantitative and qualitative analysis, you'll be well equipped to navigate the stock market's turbulent waters. Remember, whether you're an active investor aiming to outsmart the market or a passive investor riding its long-term growth, your journey through the stock market is a quest for knowledge and patience. Happy investing!